Hi everybody, and welcome to our most recent Zippy Finance educational video. Today we're going to be discussing parental guarantors. Over recent years, the average capital city house prices in Australia have risen by around 11.4%. Now that's great news if you've already got a foot on the property ladder. But if you're a first home buyer who's working hard to save a deposit, that can feel like you might just never get there. Luckily though, there are ways that you can get onto the property ladder right now without even having to sell your own mum. In fact, definitely don't sell your mum because you may need her. If you don't have a deposit and your parents own their own home, a common strategy is to apply for a parental guarantor. The benefit of this is that you may then be able to borrow up to 105% of the purchase price, including stamp duty and the other associated purchase costs. Additionally, it means you won't have to pay mortgage lenders insurance. Another benefit is that some lenders will actually also offer you a hugely discounted interest rate. And all with no deposit. Sounds good, right? But there's a few things you're going to need to know. Some lenders will accept a second mortgage on your parents' home only if they have enough equity in that property. Some lenders won't accept a second mortgage, or they may require that your parents are still earning in order to diminish their risks. There is, however, an alternative. If your parents own an investment property, or they have funds in a term deposit, those can be used as security for the guarantee. Although we said that you don't need a deposit to apply for a guarantor loan, some lenders will require that the borrower has some savings in their own name. But if you don't actually have savings, your parents can give it to you as a gift, or they could lend it to you. In addition, some lenders may consolidate any small existing debts you have into your home loan, such as credit card debt or car loans. And you should always aim to remove the guarantee as soon as you owe less than 80% of the property value, and typically this is usually reached within 3 to 5 years. Let's look at an example. Meet John. John wants to borrow $300,000 plus the associated fees to purchase property A. With no deposit, the loan-to-value ratio would be greater than 100%, which is out of lender's policy. To assist John, his parents have agreed to provide the lender with a mortgage on their existing investment property, supported by a guarantee. So the structure of John's loan would be: Loan application 1 would be in the name of John as the borrower entity, and that would be secured by property A. The loan amount would be for $240,000, which is 80% of the $300,000 purchase price. Loan application 2 would be in the name of John as the borrower entity and in the name of John's parents as the guarantor entity. It would be secured both by property A and property B. The guarantee would be $60,000 plus $3,000 fees, taking the total loan amount to $63,000. So if you are struggling to save the deposit you need to get your foot onto the property ladder, maybe it's time to be nice to your mum.